Good morning, everyone. Welcome to today's webinar. We will be covering the 2022 budget, and I'm going to also apply a bit of legislative changes. My name is Dave Beattie, and I'm the Legislative Compliance Manager at HRTorQue. I've been at HRTorQue for 23 years, and my responsibility is ensuring legislative compliance in the payroll space. And that includes PAYE, UIF, skills development levies, UIF with the Department of Labour, workmen's compensation. And generally, I would look at any legislative changes in the payroll space whatsoever, ensure that they're applied correctly in our payroll systems, and also ensure that our clients are educated in terms of legislative changes, so that information can be put into the payroll, legislatively compliant, and we can have no problems with SARS. I also do quite a bit of training, internal and external, to ensure that people are aware of changes in advance. And I think what makes us different is we are members of the Payroll Authors Group. That's a select group of 35 companies who have access to the best payroll minds in the country. So what we do is we work very closely with SARS, the Department of Labour, and the Compensation Commissioner to ensure that when legislation is mooted, that legislation works, and all the practicalities are looked at to ensure that it can be implemented in payroll systems, tested, and work from month one. We will look at a couple of issues a bit later today, where issues are not working so well. And I am going to be doing another follow-up webinar on legislative changes at the end of March. So please book on that. That's going to be looking at legislative changes in the PAYE, UIF, workmen's comp, basic conditions of employment. Anything that's impacting on payroll systems, we will look at then. The reason it's done so late is because we don't have some answers, and those answers are only going to be given to us in mid to late March, which is going to make March payrolls quite problematic. Okay, sorry, my system was just a little bit slow. Okay, so let's look at the budget that we had in late February. The new finance minister, but quite clearly the same problems. And I've mentioned the backdrop of this year's budget is quite clearly COVID. I'm not quite sure if that's a convenient excuse, but COVID has massively impacted on our economy and on the budgets over the last 2 years. I think, like all of you, our households are cash strapped. I think your middle class are suffering. You can imagine what the people below middle class are going through. Everyone's trying to make ends meet. Job losses have impacted on everyone, and businesses are struggling. I think a lot of businesses that weren't in the right space, and when I say the right space, they weren't aware of what their clients needed, may have been in trouble, and we've seen massive job losses. I mean, we've literally in our space done thousands of tax directives for retrenchment, so we know how tough things are. And we also know that companies have had to look at the big picture and change the way that their employees work. A lot of those people working from home, so we've seen companies shrinking in terms of the space that they require, and that's impacted on, obviously, the property market. Quite interestingly, the South African economy has rebounded quite nicely over the past year, and tax collections for 2021 have been massively positive. So as you can see, the collections exceeded 182 billion, and that was 62 billion rand more than the figure that was published in the medium-term policy framework. And SARS have said that that is mainly due to collections resulting from buoyant commodity prices. So I'm not sure if that's a huge win for the efficiency of SARS, but it's showing that there is buying happening out there, there is demand, and companies are doing quite well. And as a result, there's been bigger collections. However, there's a downside. July 2021 happened, and we've seen a massive slide in those commodity prices in terms of the impacts of the violent unrest we had and applicable industrial action. Also, in terms of companies battling to get back on their feet after that period, layoffs. So, yeah, the second half of 2021 was not brilliant, and we will probably only see the impact of that when stats come out a bit later in this year. We've seen a revised growth estimate from 5.1 back to 4.8%. I still think that's a little bit on the positive side, but that's what governments are going with. I put this slide in, quite interesting, to show you where this 182 billion came from. That SARS call a windfall. And as you can see, corporate income tax is quite high. It's not normally that high. So it's interesting to see that corporates and business has had such a good year. Then you can see the second biggest bar is your personal income tax, then VAT, and then your various petroleum levies, and then you'll see how small dividend taxes. So, you know, the owners of company shareholders are not pulling dividends, massive amounts of dividends out of companies. And then you can see the smallest bar there being custom duties. I would have thought that would have been considerably higher, but no. Okay, so let me move on to some concerns. Obviously, the biggest concern is the 330 billion that is going to service debt, which has reached 4.3 trillion and is projected to rise to 5.4 trillion in the medium-term framework. So what that's telling us is we're not making ends meet. We're borrowing more and more money, and as a result of those borrowings, we're paying more and more interest to third parties. 330 billion is a lot of money, and you can imagine if that was used elsewhere, how much better our economy would be. So, you know, whilst the finance minister laughs and chuckles his way through the budget speech and there's heckling, you know, the bottom line is we are paying lots of money and lots of interest to third parties, and we're paying interest at high levels because of where we stand in terms of junk status. GDP growth of 2.1% is projected for 2022. Over the next 3 years, it's expected to average 1.8. And as I've said, that is way too low to even make a dent in unemployment stats. The point at which we would start to see a change in this is like sort of 3.5%, but we're nowhere near there. So we're still in bad times, and we've got a hard road ahead. South Africa's got a very high personal income tax rate, and as I've mentioned, your personal income tax falls disproportionately on a small percentage of the tax base. Governments have said that National Treasury is committed to increasing this tax base through greater economic growth, employment and tax collection, rather than increasing tax rates. And I've added a comment to say that this is highly unlikely until the formal sector is brought into the tax net. So to get to the bottom of that, SARS has put up tax rates pretty recently. And I think they've come to the realization that they cannot do that anymore. They cannot squeeze the middle class anymore. They also don't have an appetite for pushing your higher earners because they are the goose that lays the golden egg. That's not to say that they're not going to focus on those people and ensure that they pay the amount of tax that they should be paying. But I'm firmly of the belief that we have gone quite far from 1994, and it is time that the informal sector be brought into the tax net. And when I talk about the informal sector, I talk about the spaza industry. I'm talking about people that are trading off the grid, and to a large extent your taxi industry that I'm pretty sure is not paying tax. So those people need to be brought into the net to increase the collections and make it easier on everyone. I've included some stats here. It's known that South Africa has got 62 million inhabitants. I'm not sure what the figure is in terms of if you're taking children out of that, but the grim reality is that 7 million people pay the total income tax. 2 million of those 7 million only pay 3% of the income tax. So you've got 5 million people that are effectively paying the income tax, and you would probably find that less than 10% of that total are actually paying 80% or more of the income tax. The complications that we have is that there's 18 million people, or 30% of the population, receiving social grants. This is quite clearly not a sustainable model, and it's clear to me and to a lot of people that the government has to make some hard decisions to spread this burden. I know that they don't have the appetite for increasing the VAT rate, but you need to bring more people into this net. And we can't be a country like a Northern European country, with sort of high social security payments if we don't have a net of people collecting those payments. The minister followed through with his commitment to lower the corporate income tax rate from 28 to 27%. That's a step in the right direction. And they have followed through on their promise to limit interest deductions and assess losses. So basically, structuring finances to have high interest costs to reduce profits, and companies using massive assessed losses from companies in the group to avoid paying income tax are going to be a thing of the past. The consolidated budget deficit is projected to narrow from 6% of GDP to 4.2% of GDP, still too high. The gross loan debts will stabilize at 75.1% of GDP. This percentage is obviously massively concerning because it shows how repayments costs. Debt service costs consume an increasing share of GDP, expected to be that 330 million, as I said, and that means that money, 330 billion, that means that money is no longer available to apply to education and infrastructure development, areas that would create jobs. Consolidated government spending will amount to 6.62 trillion over the next 3 years, and the social wage will take up 59, almost 60% of the non-interest spending. That shows you how much social welfare drains our fiscus coffers. Additional allocations over the next 3 financial years, as you can see, 110, 60, and 57 billion will go into prioritize certain projects. Those include, obviously, the distress grants as a result of COVID, the continuation of bursaries for National Student Financial Aid schemes, and the Presidential Employment Initiative. Now, the concern is money's been put into all of these bursaries, and I'm not quite sure what the success rate in terms of people qualifying, but the point still is if there's no jobs to go to, it's no good having qualified people in our country. So I'm not sure if that should be a priority, but it's obviously a very controversial topic, so we won't go down that road. The bulk of spending is allocated to learning and culture, social development, and debt service costs, which we've already discussed. Economic development and community development will grow faster than any other areas of the budget, and I've listed there 8.5 and 7.9% respectively. We haven't received much news on the public service wage bill, but in previous budgets, there's been talk of limited to no increases, also retiring people earlier and putting freeze on employment. The next meeting is late March, so we will only know the impact then. I'm quite keen to see if the Minister of Finance will flex his muscles. Tax revenue strengthening has significantly improved, and as I said, we're well over projections, and that is mainly in the personal income tax, corporate space, and VAT. 5.2 billion is going into the recovery efforts, and quite interestingly, we've seen some of that relief going to the fuel space. So we didn't see any increase in the fuel levies. You know, one of the places where government increases every year, but this morning's oil price of $110 and the increases we had as of today, it would probably have been the straw that broke the camel's back if government had put fuel levy increases onto that as well. So there is, I know, numerous parties looking at the fuel price mechanism as we speak, and hopefully by the next budget we'll have some answers in that space. Besides the fuel space, youth employment was also a focus, and we've seen some adjustments to the ETR, the Employment Tax Incentive space, which I'll cover a bit later. And then we saw significant relief to the tax tables, 4.5% back into taxpayers' pockets, and we will discuss that a little bit later as well. Just at a high level, we've seen obviously most of the relief in the middle income groups, but I'll show you a bit later some graphs in terms of the actual decrease in tax payable across the bands. The new SARS Commissioner continues to build the South African Revenue Service. We've seen massive changes in the IT space in terms of identifying irregularities. So they're using smart technology to identify targets, and there's been a lot of effort put into the investments overseas held by high net worth taxpayers. On the insurance side, there's an intention to consult on changes in Regulation 28 to allow for greater investment in infrastructure by retirement funds. Quite a controversial topic. We're quite keen to see if these are going to be forced investments. So is our pension provident money going to be forced to invest in South African infrastructure to create employment? Watch this space. And then the offshore limit for all insurance, retirement and saving funds is harmonized at 45%. So that's an increase over the previous year. And then quite interestingly, there's been further consultation, and there will be further consultation on the two-pot system for retirement savings. So essentially what that two-pot system means is that there is a suggestion that a third of investment savings will go into a flexible pot that you could draw against in times of hardship. For example, if we have more civil unrest and you lose your job, or retrenchment in general. And then the other 2/3 in the second pot will be your pension, which you won't be able to access under the current regulations. Quite interesting proposal. And then, as usual, we saw a 4.5 and 6.5% increase in excise and tobacco and alcohol products. No problem there. And then a new tax on vaping will come in as of 1 January 2023. We saw some increases, inflationary increases in the medical tax credits. This was a surprise because we were told that there wouldn't be any increases because government was holding back that revenue for the National Health Scheme. So I'm of the opinion that there are issues with this National Health that is holding it back. I've spoken to role players in the medical aid industry, and they say that they've had, well, there's no further information. So it looks like we're sort of moving very, very slowly in this space. So governments have increased your medical aid tax credits. In terms of the employment tax incentive, which we'll also chat about a bit later as well, you've seen a 50% increase in the various levels over the first and second years, and you've seen an adjustment in the formula. This is an incentive that government believes is going to create employment in your low sector amongst youth. Whether it's very successful, I don't know. I haven't seen any stats in this space, but what is concerned is the abuse of the ETR incentive. We've seen massive schemes developed to milk the ETR incentive, and we've seen companies get into lots of trouble in this space. So if you are using a third-party company to source employment in inverted commas, and you are claiming ETR, please communicate with us and we will point you in the right direction in terms of what is allowed and what isn't allowed. That will also be covered in more detail at the end of the month webinar. So there's your new tax tables. Not such an interesting slide, but it just shows you what's applicable from 1 March 2022. There's your primary rebates, secondary rebates, and tertiary rebates, which we will have a look at a little bit later. In fact, we'll look at them now. Okay, so this slide is an interesting slide. This shows you the levels of earnings, taxable income down the left, and then on the right-hand side, you've got your actual tax savings. So you can see here that if you're under 65 and you earn around the 200,000 mark, you'll pay 711 Rand less tax, which is 3.5%. And you can see how that percentage cascades down to, if you're earning 2 million, you're only paying 1.1% less tax. Here's a slide showing those people who are between the ages of 65 and 74. And as you can see, someone earning 200,000 is going to pay 9.4% less tax, and someone earning 2 million, 1.1%. So quite a nice adjustment if you're earning in the 200,000 space, if you are a pensioner that is doing some work and falling into that 200,000 category. And then here's your 75s and overs, and as you can see, the big winners are the 200,000 space. You're paying 13.9% less tax, and if you're earning 2 million, you're only paying 1.2% less tax. So lots of savings to those people who are in the pension space, which I think is good. And then some quite nice changes, you know, sort of inflation-linked changes for those people who are in the middle income bracket. Okay, so this slide covers your medical aid tax credits, and as you can see, for the first two people, it's gone from 332 to 347. Not a massive amount, but not to be sneezed at. And then for every additional dependent, it's gone from 224 to 234. And then what I've done is I've included the formula below that for the secondary medical tax credit. This is a formula that people don't often pay attention to. And as you can see, the formula is different for those people who are under 65 to those people that are over 65. If you're under 65, your benefit is lower than those over 65. And I've noticed, you know, particularly doing provisional tax credits for people over the age of 65, how massively this secondary medical aid tax credit impacts on their tax liability. And that's just taking into account medical aid premiums. I'm not talking about additional qualifying expenses. But if you're under 65 and you've got a young family, you'll know how high your additional medical expenses are. In other words, those expenses that are not covered by medical aid. And this, if you do incur all those expenses, you need to know that you're not getting a rand for rand tax deduction for those expenses. You'll see that there is a formula that you have to apply, and you have to exceed certain expenses before you get a benefit, and then that benefit's divided by 4. So it might not be as high as your pensioner credit would be, but it's important to keep those expenses. Please note that it's not good practice to put that through the company payroll, and that I always recommend companies, if their employees have these massive amounts of additional medical expenses, that they hold those till tax return time and claim them on assessment. In terms of local interest, you'll note that these exempt amounts of 23,800 for under 65s and 34,500 for over 65s are unchanged. Those have been unchanged for more than 10 years. Your pension fund contributions and deductions all stay exactly the same. In terms of travel allowances, the new travel tables, and when I mean travel tables, I mean those tables that are applicable should you want to claim a travel deduction against a travel allowance. That table hasn't been published yet. We expect it to be published in the next 3 to 4 days. So the rate of R3.82 per kilometre, if you're going the reimbursement route, is last year's rate. As soon as we've got this year's rate, we will publish it, and it will be covered in the month-end tax updates webinar. So there's your travel deduction table. That's exactly the same from 2022, so I can't expand on that. Quite interesting it'll be quite interesting to see if SARS increases or decreases these. I'm hoping that they increase the elements because the fuel price has taken a massive hit, but SARS will look at their stats over the previous 12 months and make a call. Your subsistence allowances change every year, and as you see, the incidental rates has gone up to 152 Rand a day, and if you're going away overnight for meals and you're getting incidentals, that is 493 Rand. And then, as I mentioned in the webinar last year, the legislation was changed in March 2021. If you've got an employee that's going away for the day, you can still give them the 152 Rand to cover meals and incidental costs without them bringing you vouchers. You would have to record that on the payroll, though, and you'd have to set up systems to cater for that. In terms of severance and lump sum benefits, everything stays exactly the same. As I said, we started to see a lot more severance benefits paid out and ex gratia payments paid out. And this slide is just there to show you that you can only apply for these should you be older than 55 or older. There's some sort of sickness or ailment preventing you from working, or you're retrenched due to the fact that there's been a downscale in jobs at your employment. Your severance benefits tax tables are unchanged from 2022, and so are the tables that would be applicable if you withdraw from a retirement fund under the age of 55. The table just shows you the SARS interest rates. As you can see, the fringe benefits rates, if you're providing interest-free loans to your employees, 5% is the rate that you need to charge for there to be no fringe benefit. If you're charging under 5%, you need the 5% loaded into the payroll to calculate the monthly fringe benefit tax on the interest that you should have paid. And then you'll see most of the percentages of 7.25%. Except if SARS owes you money from provisional tax, as you can see, they pay you a measly 3.25%. Okay, the only change to tax rates and tables in the small business or in terms of turnover tax is the 27% that is applicable to corporates tax now, as opposed to the 28% that it was previously. Here's your turnover tax tables. Not that I deal with many of these, and I'm pretty sure there's not many of them around, and I'm surprised that SARS persists with this. Okay, just to move on to some legislative matters. As I said, all these are going to be covered in depth at the end of the month, but I just thought it was important to show you that these are the new employment tax incentive tables, otherwise known as ETR. And as you can see, there's been an increase in the percentages, and you can see there's been an increase in the amounts. So make sure that these are correctly implemented in your payroll from March. There is some challenges in the space, though. The Treasury have said that they want to increase the value, which they've done by implementing these new tables. They want to expand the criteria for participation. So we wait with bated breath to find out what that relates to, and to make it easier for small businesses to hire people. Well, they would make it easier to hire to young people if they make ETR easier to implement. As you can see, they've published this information now, and there's still lots of questions as to the ETR space. Is not as easy as just putting this into payroll. And as at today, Payroll Authors Group are waiting for feedback on a lot of issues from SARS. So what that means is, those companies that run payrolls early in the month are potentially going to be running their payroll based on information that we know to date, and there could be some challenges dealing with reporting after the first 6 months if the reporting in month 1 differs from reporting in the next 5 months, particularly when it comes to those interim IP5s. So we're hoping to be able to publish some information in the next week or so. There has also been a change to the definition of monthly remuneration, and that's going to complicate things massively in terms of the interpretation. What is monthly remuneration? And it's important to note that fringe benefits must be excluded from the definition of monthly remuneration. So taking monthly remuneration out of taking fringe benefit out of this monthly remuneration is potentially going to open ETR benefits to more people. There's also, from an interpretation perspective, we're interpreting that you must reduce this remuneration by tax deduction allowable. So hopefully that means that your taxable income is, for these qualifying employees, is now within the ETR qualifying brackets, and that you'll be able to claim ETR for more people as of 1 March 2022. But watch this space, we don't know. Long service awards, this has been looked at finally. In my audits of payrolls, I pick up lots of problems in this space. Just a quick reminder, long service means an uninterrupted work history in your company of 15 years. And then the employee would qualify for every 10 years at the same employer, uninterrupted employment after that. So that means you qualify for this benefit after 15, 25, 35, 45, 55 years. So remember that if you pay after 17 years, it would then be 17, 27, 37. So you can't alter. It has to be according to those periods. Now, The legislation has always been, you've had a 5,000 Rand exemption, and that has to take the form of an asset. If you give a person cash, that is fully taxable. Well, that changed as of the 1st of March. So you now can give someone 5,000 Rand in cash as a thank you for 15 years of hard, unbroken service. The use of gift vouchers, just to clarify, has always been fine. I know that some companies have been a little bit touchy on that. A gift voucher enables you to purchase an asset. So the link between the asset and the voucher is very close. So you can go the gift voucher route. And then for those interested, if your employer gives you Kruger Rands, that's an asset. And the 5,000 would apply to that asset. So in terms of working out the long service calculation, you need to obviously make sure first that the long service conditions have been met. The value of the award must be determined, and then you're obviously going to then determine whether there's a fringe benefit. So if, for example, the benefit was 8,000, you know that the benefit is only 5,000, then there would be a fringe benefit of 3,000. But there is a new RP5 code, as I've said there, 3835, and that's going to require changes to payroll systems. So you will put the total amount that you pay to the person into this code, and then there will be a reduction by SARS for the 5,000 Rand, and then only the remaining amount is going to get taken into taxable income. Should you go the route of giving someone an asset in lieu of a long service award or the right to use an asset, then you would still put that value, fringe benefit value, into code 3835 and not into the normal fringe benefit codes of 3801 or 3806. So if the person, to summarize, if the person is getting a long service award, that award has to go into 3835. Any other people, the fringe benefit would go into the normal 3801 or 3806 codes. PAXA, Payroll Authors Group, have been pushing SARS to increase the 5,000 Rand exemption to make it more relevant to 2022. But in the 20 years, SARS have resisted this, and they've resisted it again this year. UIF compliance certificates. This is the bane of my existence. As you know, in 2021, a new online system was developed. So you go into compliance on the UIF website and you can register your company and at the click of a button, request your compliance certificate. If only it was that easy. We've had lots of challenges with the system freezing for days on end, not to mention the rejections that come back. So just to set the scene, we could be running your payroll and submitting your declaration file correctly for the last year. When we apply, or you apply for the certificate, it comes up with 3 pages of rejections going back to 1959. We've had huge problems in this space. We've done everything in our power to fix it. We have regular meetings to try and troubleshoot and to try new things. We've referred this numerous times to the Payroll Authors Group, and they are just as stumped as we are. So you won't get feedback from the Department of Labour. We've had webinars with them. People at a low level are very happy to try and help, but it never goes past their boss. And we get the impression that senior managers at the Department of Labour are digging their feet in and not wanting to help in this space. As I said, PAXA, South African Institute of Tax Practitioners, and the South African Chartered Accountants are all addressing this issue. We've been told that there's going to be a Supreme Court action, class action shortly by companies who are going to take the Department of Labour on for potentially sabotaging tenders. We've also been told that a big media house is going to get involved from the simple angle that they can't actually do publishing work for the Department of Labour themselves as they normally do, because they require a certificate of compliance to do so, and they've been faced with the same challenges that all of us have. So those of you out there who are desperately in need of a certificate for a tender, there's just no solution at this space. We're hoping that carte blanche are going to get involved and this media house, and that's going to stir the Department of Labour into action. But obviously we're concerned about poking the bear at this point, because we have to work with this organisation afterwards. In terms of the Basic Conditions of Employment Act, you would have noticed that we published in the last month or so an increase in the earnings threshold from 211,596.30 cents to 224,080 rand and 48 cents. That's applicable from the 1st of March. And this is the rate in which, should you exceed, you do not qualify for overtime, and you don't get automatic protection in terms of the items that we've covered in the slide below. So you'll see that impacts on rest periods, night work, ordinary hours of work, compressed work weeks. If you're under that threshold, you get more protection than should you exceed that threshold. Then very recently in February, we got the new national minimum wages. And as you can see, that the general national minimum wage of 23.19 Rand per hour applies to general work, domestics, and farm workers, with the only sector lagging behind is your public works program workers, effectively government created employment. And interesting to see that the government have worked quite hard to get domestics in line with the normal minimum wage, and that has been achieved now in 2022. Just a slide on whether independent contractors are applicable to receive this national minimum wage. A little bit of a technical issue. No, they're not. So independent contractors are excluded. However, independent contractors are not excluded from your different legislations in terms of ETI and UIF. Okay, here's your table. This is just for information's sake. This is published in terms of the Skills Development Act to show you what pay has to be paid to learners. And as you can see, there's been quite a nice increase across the board there. And then this is an issue I'm going to discuss at length at month end. The first chapter just talks about the independent contractor angle, which we've already spoken about. But what's important is you look at, when applying the national minimum wage, it's important that you look at this definition of wage. What falls into the definition of wage? Okay, and quite simply, wage is the money that is paid to the worker in respect of ordinary hours. So it's your very, very base wage. Okay, it doesn't include all your other benefits. Okay, so we're talking about cash and employer contributions, and any fringe benefits do not fall into this definition. Okay, just a quick word on Poppy. We all know Poppy came in on the 1st of July 2020. There was a 12-month grace period, and we've had a bit of a concession in terms of Section 58.2 of Poppy, which was postponed to the 1st of February. We've passed 1st of February, so Poppy should be in full swing. It's important that you understand the full Poppy employment life cycle in terms of engagement, onboarding, management, termination, and separation. It's important that you've got a Poppy policy. and that you are following the rules in terms of illegal disclosures or issues where private information has fallen through the cracks. But you're welcome to chat to our team if you've got any questions in that space. This issue, gift vouchers and other benefits, I just included it, because people in the payroll space believe that you can, in lieu of things like overtime, you will give a gift voucher or some sort of a benefit to your staff. SARS will catch you and they'll find that in your cash book the first audit they do. So please don't go down that road. Gift vouchers are taxable benefits. Giving your employee rights of use of a company asset, giving your employee the company car for free or at a market, or at a value below market value, is a fringe benefit. Please, if you're going to do that, talk to us. We've come to the end of the issues for today. Sorry, I'm just trying to see. Okay, we've got no questions, but we are going to send out the slides. And as I said, if you're in the payroll, financial, HR space, please book for the webinar at the end of the month. It is free. I'm going to go through everything in a lot more detail, and I'm sure there'll be lots of questions. Alternatively, you're welcome to drop me an email anytime to chat about issues. It's important that you resolve issues before you make mistakes, and I've seen lots of mistakes in the areas that I've discussed today. I do audits all the time, the long service, the ETR, the assets, giving company cars to employees is very, very popular at the moment. I can talk you through that process, and don't let a small issue become a big issue. Chat to us and we will help with pleasure. Thank you today, and if you want to listen to the webinar again, it'll be put on YouTube like all of our other webinars. Thank you, and thank you for supporting HR Talk. Have a lovely day.